Hello, everybody, and welcome back to another episode of our Southern California Market Housing Podcast. My name is Stephen Meade. I'm the principal broker at Domicile Real Estate for people who love houses. And this is our whole Southern California market update, looking at both entry level and higher price points. And before we begin, want to talk about, when you make these observations of the market, I always think it's interesting to sort of watch what other people are saying about the market. We make our own conclusions, and we tend to stick by them for the most part. One of the things I talk about frequently on here is that there's a pretty common pattern which occurs, and that is something changes in the market, something drastic, an event, interest rates, something big happens. There's news. There's a period of 30 to 45 days where the market is kind of in a bit of turmoil and trying to find its feet. And then it settles in and finds kind of a new equilibrium point, and there's a new sense of stability. And last week I talked about, I thought we were reaching that point, and I think that's confirmed with the data this week, which is really kind of interesting. Interest rates have largely stabilized. I think that was kind of our market shock that we talked about. And, we saw while buyers kind of dropped off a cliff initially, a lot of them came back into the fold, and the data really supports that. So let's not delay any longer. Let's get right into it. So first thing is, let's talk about active listings in our market. So if we look at our active listings here, under $1 million, we are clearly more than we were last year. We were 6,000 or so. Right now we're at about 8,000. So that's a 25-30% increase. But look at how it's completely leveled off and is no longer growing. So that's a sign really that the market is kind of finding a place of stability. This period here is the market changing and seeking that stability. And in our $1 to $2 million price category, same thing has happened. Look, we have a number of weeks of really being at the same sort of data point. So signs of stabilization both at the low end and kind of in that higher end of the market. Just as a reminder, this is Los Angeles and Orange counties. We move on here. This is new listings over the last 14 days. This number has dropped precipitously, and we've seen this anecdotally, right? It feels like there are less new homes coming on the market. And, there's a couple of reasons for this. One is kind of this idea of a lot of sellers are saying, well, why would I trade my 3% mortgage for a 5-point-whatever% mortgage? So a lot of those move-up buyers are deciding to keep their houses off the market. Secondarily, something else we're seeing is when people drive around their neighborhood and they see a bunch of for sale signs, they are less inclined to want to put their home on the market. And I think that's what we're seeing, right? We're seeing that sellers are not feeling nearly as confident. They're reading stories in the newspaper about how the market has slowed down. And I'm just going to take an aside here. I mentioned this, I think, in our first-time buyer market update last week. But here's really the chain of events, right? So the way I look into this is most consumers think that the real estate market that we talk to, their perception of the real estate market is what newspapers and online news websites were saying 30 days ago. And those newspapers and online websites and news sources, they are reporting on what the market was 30 days before that. So the reality is most consumers are about 2 months behind, in my experience, with where the market actually is. They're not in the market actively looking at homes and out there. They're about 2 months behind. And so what I think you have happening here is you've got a lot of sellers who are operating off that data from 2 months ago. So we're seeing a general reduction in the number of new listings. We're seeing this in both price categories, under $1 million, which is entry level, and then $1 to $2 million as well. We're seeing that those numbers of new listings go down. But what do we see here? Our new escrow number, those have rebounded a bit from several weeks ago. So buyers who are in the market, on the other hand, aren't treating this the same way. And there's a fundamental disconnect. We talk about buyers and sellers being flip sides of the same coin, and that's true. You need a buyer and a seller to make a transaction happen. But the way they interact with the market and their thoughts are very, very different. Sellers are largely not as involved in the market. Buyers, by the time they get an offer accepted, they've usually been searching for several weeks, and they have much more current perception and market data. Now, if you look at our absorption rate, right, those kind of got down towards this 50% market, right? That's really close to an equal market, or even a mild buyer's market, and both of those have rebounded. The under 1 million has rebounded over 70%, right, almost mid 70s, and then we're kind of in the high 60s here in our $1 to $2 million category. So these absorption rates have rebounded a little bit from their low points, meaning the market's a little bit more competitive. If we look at our pricing data, right, and we divide this kind of into three sort of tranches or groups, 25th percentile is our entry level category. What do we see happening in this price point? We did see a crest and a light decline, but to be honest, this isn't a huge price crash. This isn't the kind of crash people were looking for. Same thing on our median here. Yes, it's a very gentle slope. There's a little bit more of a downward trend on the 75th percentile, which is kind of that upper end price point, right? If you look on the graph, that's between $1.25 and $1.5 million. You definitely see a little bit more of a downward trend line. But remember, these are also homes that are twice the price of our entry level 25th percentile. So you're going to see a little bit more movement, and it might be the same percentage of movement. So, the story here is none of these are drastic price declines, which is what I think people would have expected 2 months ago. Now we have our percent still active after 14 days on market. This is another measurement of market competitiveness. When these numbers are higher, it is a less competitive market. You saw these went up, but again, they have stabilized out, right? And that indicates, again, we're in a market that is at a stable point. We're at a sort of finding an equilibrium. And then the other thing that sort of really needed to happen, we talked about it quite a bit, it is our close to list ratio. And where are we with our close to list ratio? Right near 100%, meaning on average, the close price is the same as the list price for the property on average. What's a normal number here? Anywhere between 99 and 101% are kind of where our market normally is. So this is what I like to call that measurement of trying to see what is the difference between seller perceptions of the market and buyer perceptions. When those perceptions are somewhat in line on pricing, you're close to 100%. When buyers have a much more frantic view of the market than sellers, you tend to start seeing these numbers go way over list price. Our days on market for new contracts. Yes, that was below 20 days for a while. Then it moved up swiftly, and now again, that is stabilizing out, still under 30 days, which is a very quick period of time. The homes that are desirable are still selling relatively quickly. And then we have our three-way graph, always my favorite. If we go back to June of 2018, and we kind of mark those as our baseline at 100%, where are we on our payment index? We're right here about 150%, meaning the payment on a median priced home today is 50% higher than it was in June of 2018. That is 4 years ago. The rent index is about 141, 142% of where it was in 2018. And our CPI index is just about 119% of where we are. Is this unusual? Not particularly. Again, the big thing that we're looking to track is this differential when you see rents rise and housing payments rise. How are these tracking? Are we getting into a situation where the payments on housing are tracking way higher than the rental on housing? That's sort of an unsustainable situation when you see this wide gap here. That's really what we're looking for. And look at how close these are right now. We've actually backed off a good amount off our peak payment here. So you see these numbers really are suggesting this is a market that is fairly stable. It's not kind of out on a precipice or set for a collapse. And then the other good news here is interest rates. They did a march from 3 to 5%, and then kind of jumped up almost to 6%, and then have eased back down a bit. Really we're in the low 5s right now. We measure this once a week. But this really has provided some of that relief, but I think it's also provided a lot of confidence for people that the sky is not falling. I think the Fed has woken up, and they are finally actually starting to do things that are giving the market a little bit more confidence. Ironically, we're going to do a video on this. As we mentioned last week, we were moving to doing our market videos every 2 weeks and alternating between our whole market update and our first time buyer market update. So this week will be our whole market update, which is what you're watching. Next week, we will do a first time buyer market update, and it will be 2 weeks before you see us again for a whole market update. But that's going to let us do some videos on some other topics. I think our first one is going to be why Fed rates have nothing to do with mortgage rates and why it's just really a bad thing to look at or consider. You probably heard that before, but we're going to actually tell you why that is and what that rate actually means. So looking forward to doing that video for you. Don't forget to like, subscribe, and hit that notification bell. As always, questions, comments, we love them. And if you are looking to buy or sell real estate in Southern California, we would absolutely love to lend you our expertise. There are ways to reach out in the comments or in the description down below. We will see you again real soon.